You hear trade war, and what do you picture? Chaos, right? Blaring headlines, politicians yelling, and stock markets just bleeding red. It feels like pure, unadulterated risk. But here's the thing. Behind all that noise, there is a completely different game being played. It's a game of rules, of structure, and frankly, of huge opportunity for people who know the playbook. So today, we're going to pull back the curtain on what I'm calling the chaos trade. All right, so let's start with a site that is probably all too familiar if you've ever looked at a brokerage account. That instant gut punch reaction the market has to any kind of big geopolitical news. This is what it looks like when a trade war hits the tape. I mean, look at that! The S&P 500 dropping over 10% in just 2 days. For most folks, that's a giant flashing sign that says, sell! Panic, get out, run for the hills before it gets any worse. It's just a sea of red. But what if I told you that for a totally different kind of investor, this stomach-churning drop isn't a threat at all? In fact, it's the exact opposite. It's a signal. It's like the starting pistol firing, telling them, okay, the game is on. Okay, let's really get into this. To understand this game, you have to learn to see right through those scary headline numbers. And we're going to start by peeling back the very first layer of complexity, which has to do with those tariffs you're always hearing about. You know how the media loves a big, shocking number? We get bombarded with these claims of ridiculous tariffs, 250%, 300%. It makes it sound like there's this impenetrable tax wall being built between countries, right? Like all trade is just grinding to a halt. But the reality, it is so much more nuanced. And it all comes down to this really critical concept, the tariff rate quota, or TRQ for short. See, it's not a flat tax, it's a two-tiered system, and that little detail changes absolutely everything. So here's the crucial point. That terrifying 250% number? That's not the tax everybody pays, not even close. It's what's called an over-access commitment. Think of it like a penalty that only kicks in after a country has already shipped a huge pre-agreed amount of something. Below that quota, the tariff is often zero, nothing. And get this, in a lot of cases, like U.S. dairy going into Canada, that quota doesn't even get filled. So you see this gap, right? This massive chasm between the scary headline and the, kind of boring and complex reality. That is precisely where the smart money finds its edge. They use a strategy called arbitrage, and it's basically the art of exploiting tiny little differences in price or information. Now, to really get this, we've got to look at the legendary, and let's be honest, cautionary tale of a hedge fund called long-term capital management. These guys were the absolute masters of a certain kind of arbitrage. They truly believed their math models were basically a crystal ball for the markets. Their signature move was something called bond arbitrage. It's a three-step dance, basically. First, they'd hunt for tiny, almost imperceptible price gaps between two bonds that were nearly identical. It's kind of like finding two identical cans of soup in the grocery store, but for some reason, one's a penny more expensive. Step 2, place the bet. They'd sell the expensive one, that's called shorting, and buy the cheap one. They were betting billions that this tiny little price gap was going to disappear. And finally, step 3, collect the cash. When those prices converged, which they almost always did, they'd close out the trade and pocket that tiny difference, but magnified by an insane amount of leverage. Now, their models, these things were built by Nobel Prize winners, and they told them that a catastrophic loss was a statistical impossibility. They literally said it was an event so freakish, it shouldn't happen even once in the entire lifetime of the universe. And yet, you know where this is going, it happened. Just 4 years in, the whole thing collapsed in a way their math said couldn't happen. It's just a brutal reminder that even the absolute smartest people in the room can completely misjudge the real risk hiding in all that complexity. So while the pros are playing these crazy high-stakes arbitrage games, a lot of everyday investors are, without even knowing it, walking straight into these structural traps. And they're baked right into some of the most common products you can buy, especially when a crisis hits. Let's take a closer look at a classic trap in the oil market. This thing pops up almost every time there's a big geopolitical mess. It's a phenomenon called contango. Yeah, it sounds complicated, but trust me, the way it works is simple and it is a brutal, brutal destroyer of wealth. So here's how this trap springs on you. You know those popular oil ETFs, the ones most people use to bet on oil prices going up? Well, here's the secret.
they don't actually hold any physical oil. They own futures contracts. And since those contracts expire every single month, the fund has to sell the contract that's about to expire and buy the contract for the next month, just to stay invested. And in a contango market, that next contract is always more expensive. So think about it. Every month, the fund is mechanically forced to sell low and buy high.
This purely mechanical process, this roll, it creates this hidden drag on your investment that just eats away at your money month after month. And the cost is absolutely staggering. You could see an annualized loss of 13% just from this roll yield alone, even if the actual price of oil doesn't fall a single penny. The takeaway here is just brutal. With these ETFs, you can be 100% right about where oil is headed, and you can still lose a fortune.
So, okay. While you've got everyday investors getting caught in the gears of this formal market, getting chewed up by things like contango and roll yield, there's a whole other game going on, a much deeper game, played far, far away from the public eye. And that's where we get to the shadow market. This is where the real insider play happens. It's a world driven by concepts you are never, ever going to hear about on TV. Things like the ghost fleet and the dark swap. This is a perfect illustration of how it all works. A conflict blows up, and the big insurance syndicates in London just declare an entire region a conflict zone. All of a sudden, the cost to insure a single oil tanker for one trip skyrockets. I'm talking from maybe $40,000 to $6 million. It's basically an insurance blockade. But the world still needs oil, right? Demand doesn't just vanish. So instead, this ghost fleet of older uninsured tankers emerges from the shadows to fill the void, moving sanctioned oil around the globe. They turn off their tracking systems, they swap their flags in the middle of the ocean, and they conduct these ship-to-ship transfers to completely bypass the entire formal dollar-based system. It's a whole parallel supply chain born out of pure chaos. So, what's the big takeaway here? What does all this mean? Well, it's about a fundamental shift in how you think. It's about learning to see the world less like someone reading the headlines and more like a plumber. Think about it like this. The retail view is to see that scary headline and just panic. The insider view, they see legal and structural complexity and they start looking for the angle. The retail trader buys the popular oil ETF because they saw something on the news. The insider understands that it's the ghost fleet and the dark swap that are actually moving the market at the margins. That's where the real information lives. They don't trade the news, they trade the plumbing. You know, the legendary investor Benjamin Graham nailed this idea perfectly. He said there was this old Wall Street motto, never buy into a lawsuit. But his genius was realizing that the general public's fear of anything messy or complicated, that's the very thing that creates the bargain opportunity. That aversion to complexity is what pushes prices way down to unreasonably low levels. And that really leaves us with the big question, doesn't it? The real edge, the real alpha, as they call it. It isn't about trying to predict tomorrow's headlines. It's about having the courage and maybe the patience to dig in and understand the complex, messy, even boring systems that everyone else is either too afraid or, frankly, too lazy to look at. The chaos isn't the risk. The chaos is the opportunity. So the question you should be asking yourself is, what complexity is everyone else running away from today?